It's absolutely absurd. People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. They're not discouraged, they just think it's a gamble. So therefore they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less, don't own it. Because when it goes down, let's say the stock goes down 2 points.
You won't understand what's going on.
What do? Do you buy more? Do you flip a coin?
And chances are your broker doesn't either?
He or she certainly doesn't know about it. I mean, who knows what all these things are with auto-back planes and mega flops? Who knows what all this is?
So buy what you know.
Buy in your industry, buy what you know, buy local companies.
Yeah, so suppose you don't have an industry. I mean, you don't really...
You buy local companies, companies in your own industry. 10 years after Walmart went public, 10 years after
Walmart.
Went public, 10 years after it went public, it's a 25-year-old company now. You could have bought the stock and made 50 times your money on it. 50 times.
This is if you bought it 10 years after
it was public already. It had already gone up 5-fold. So you could have made 250-fold. But I'm saying, let's say you were in a town, they came into it and they said, boy, these prices are great, they're doing terrific, I like the bargains, and you checked it out. You spent a little bit of work on it. I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's only 10% of the country, they're not even saturated there. Why can't they go to the rest of the country?
So this is more of the same, is it what it is?
It's more of the same, plus I show examples. It's a touch more detailed. It actually shows me in action. I picked 21 stocks early in 1992. Some work, some don't. I follow those companies. Some of the companies, the fundamentals deteriorate. Some they improve. I watch those companies go through the year. I also explain the retail industry. I try and make it very simple. And I talk about a wonderful example. It's a 7th grade class. The teacher of that read my book, and my first book that you were talking about. She read the book, and I said, if you made it through 5th grade math, you can do it in the stock market. She says, okay. She started teaching it in 7th grade class. These kids had to study companies. They had to look at their balance sheets to see if they're solvent. And they picked stocks. These stocks were up 69% over 2 years, when the market was up only 20%. They picked stocks like Limited, they picked the Gap, they picked Walt. They understood these companies. They also picked IBM. I lost money on that too. I mean, everybody makes mistakes.
Everybody did,
But I'm saying this was a school, St. Agnes' School in Arlington, Mass. But in addition, in the decade of the 80s, there's 8,000 investment clubs. These are amateur, sort of average people just investing. These investment clubs, 62% of them, of these clubs, beat the market. In the decade of the 80s, only 25% of professionals beat the market.
Let me go back to one other subject. You're coming back to Fidelity, aren't you? Aren't you going to do something?
When I finish this book, I've been working about 1 or 2 days a week the last year and a half on this book. Now I'm done with the book. I'm going to go back to maybe 1 day a week, working with the younger analysts, just listening to them, talking to them. I'm not telling them to buy Xerox,
so you're not
to sell Xerox.
your old lifestyle.
Not totally. I'm not going to run another fund. 13 years was plenty of running a fund. I'm just going to work with younger analysts, let them ask questions, I'll ask them questions. It's going to be a lot of fun.
And do you still do you manage any money for anybody other than yourself?
No.
Are you happy you did this? I'm
delighted. It's great.
And you like your new life?
Oh, it's fabulous. You absolutely have to invest more in education. You have to invest more in companies. You have to invest less in just spending money. I mean, today people are encouraged to spend. You spend money. Let's say you put an addition on your house. You spend money on that. You can get a tax deduction because the interest on it is tax deductible. If you take your money and put it in the bank, you're taxed at a very high rate.
You wrote a book called One Up on Wall Street, and I think that's one of the best-selling books ever about Wall Street, if I'm right. You can correct me. And so why then did you write another book?
Okay. I think the reason I wrote it is I try to explain to people their great advantages, their edges they have, and that they should get involved in stocks, and they should do it on the right basis.
This was on the first book.
Right. And obviously, I didn't make a great impression because the percent of people's assets involved in stocks has gone down. In 1960, people had 40% of their financial assets, including their house, in stocks and mutual funds. In 80, that was down to 25%. It's now down to 17%.
And why do you think that is?
Decade of the 80s was the best decade this century for stocks. I think people managed to lose money in the 80s doing it themselves because their methods were so flawed. So I really feel as though I wanted people to understand. I don't want anybody to buy a stock. I'm saying if you're going to buy a stock, you should do certain things.
Right.
If you're not willing to do these things, you should leave your money in the bank.
Your philosophy is simple, and I'm remembering this from the previous book. I think we're now talking about the previous book.
Correct.
Your philosophy was, if you find something that you identify with. I remember there was a story of your wife and her hose.
Yeah.
Your wife kept saying,
legs
these
and
are
the panties. Oh, you got it.
Yeah, the legs and panties. Your wife said, these are the greatest things I've ever seen.
Right.
And when your wife said that, you knew that this was a product that was better.
Right.
You used to stay at La Quinta Motel.
Right.
And the service was better, whatever was better.
Right. The price was good.
And
too.
the price was good too. And you said, this is a place that I can determine. I, Peter Lynch, can tell that this is a good product, right?
That's right.
And if these people are making a good product, then their earnings are going to go up, therefore the stock's going to go up.
Right.
And that's the kind of decision-making process you ought to go through.
Right.
Do I have it?
You've got it exactly right. Well, I don't think people understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. McDonald's has done very well as a company.
Right.
The stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
It's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
But
I'm saying people have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products, you supply kitchen equipment, you help build restaurants.
Right.
You saw McDonald's, you saw Chi-Chi's, you saw Chili's, you saw Cracker Barrel, you saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry. People are in industries. They're in the publishing industry, they're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need in a lifetime? Instead of people that are in the restaurant industry, they're buying biotechnology stocks. The people in the chemical
know
industry
nothing about
know nothing
biotech.
about it. The people in the chemical industry are buying oil stocks.
Right.
It's absolutely absurd.